Hi everyone, my name is Vishavjit and I'm founder here at Quicko. Today we're going to talk about income tax for investors and traders. Now you may ask why now? As some of you may know, 31st July is the due date to file your income tax return. So there couldn't be a better time. There are only about 10 days left. So if you haven't filed your return already, please do. And hopefully this video will help you understand how to. Before we start, let me very quickly introduce you to Quicko. So Quicko is an online tax planning and filing platform. We help individuals and businesses stay on top of their tax compliances. We are also Zerodha investee startup and we are really proud of it. So today we're going to talk about if you have a Demat account with Zerodha and if you're trading and investing into capital markets, how can you file your income tax return very easily using Quicko? So without further ado, let's get started. So I'm going to broadly cover three topics. I'm going to talk about income tax on investing and trading activity. We also going to talk about some tax documents. There's a lot of curiosity. Income tax department introduces a lot of new tax documents. So we're going to talk about some tax documents. And finally, I'm going to show you how you can file your income tax return. We'll try to keep it very crisp so that you stay engaged and hopefully you learn and take away a few things from this video. So I think the most fundamental question we need to ask is difference between trading versus investing, right? Tax treatment completely depends on your intent. Now, what does that mean? So investing is done with an intent of long-term capital appreciation, right? And hence investing is taxed under head capital gains. On the other hand, trading is buying and selling of stocks and other securities such as derivative contracts. So we are talking about futures and options contracts here with an intent to earn profits due to fluctuation in prices. Hence trading is taxed under head business and profession. So there are a lot of traders, investors who ask us question whether they should report their trading/investing activity under income from head capital gains or business profession. And the simple answer is you need to always fall back onto intent. We get a lot of questions where reporting trading investing activity under capital gains versus business profession can have a favorable impact on your taxability and can reduce your tax burden. However, in past we have seen that that's a practice you should always try to avoid, right? Because if in case there is a scrutiny, you will have to justify why it is either investing or trading intent. Cool. So I hope now trading and investing is clear. So let's move on to how are different segments taxed and what is the tax treatment, right? So what we have done is we have broadly divided segments that you all understand and are familiar with. We're going to talk about income head and what tax rates are applicable on those income heads. So first and foremost, equity shares, mutual funds and ETFs. Here we primarily talking about equity MFs and ETFs. So they are considered securities because STT is paid. STT is security transaction tax, and whenever STT is paid, the capital gains incurred from selling of those kind of assets are considered securities capital gains. Now, how are they taxed? So if you hold them for less than 365 days, that means duration between the date of purchase and date of sale is less than 365 days, then it's considered short term and they are taxed at 15%. However, if you hold them for more than 365 days, they are considered long term and they are taxed at 10%. There is also an exemption up to 1 lakh rupees under section 112A, right? What does that mean? That means if your capital gains are not more than 1 lakh rupees in a given financial year, then they are completely tax exempt. Now, debt MF, ETFs and foreign securities, right? When I talk about foreign securities, there are a lot of foreign direct investment platforms through which you can, there's a craze to right now own FANG stocks. So if you're doing, if you are investing through one of those platforms, then that's what we mean by foreign securities. Then it's considered other capital gains because it's highly likely that STT is not paid or it's a debt instrument, right? So in that case, the holding period, if it's less than 3 years, then it's considered short term and they are taxed at slab rates, just like salary income or any other income. And if they are held for more than 3 years, they are considered long-term capital gains and they are taxed at 20%. Now, similarly, bonds and debentures, government securities, treasury bills are considered other capital gains, and there's a similar kind of holding period and tax rates applicable on those as well. Now, we often get a lot of investors, traders who have in past couple of years started trading and investing. As you all know, there's a tremendous rush of retail participation into capital markets over the last few years since COVID pandemic started. And we get this question asked very frequently. What's the difference between tax treatment of intraday versus cash and carry or delivery, however you want to put it? Like we already talked about, cash and carry or delivery is taxed as capital gains, and the short-term and long-term rates are 15% and 10% respectively. However, intraday, where you essentially are not taking delivery, but buying essentially a contract and selling it on the same day, then it's considered intraday trading. Now, short sell is also considered intraday trading. So in those kind of conditions, the income will be reported under head business and profession, and it's specifically called speculative business and profession because you are not taking delivery of the securities, and they are taxed at slab rates. F&O on the other hand are considered non-speculative business and profession income, and they are taxed at slab rates as well. We have a lot of youngsters who use our platform. And a lot of you also may have, ESOPs or RSUs. You may be working for a startup here in India, or you may have worked at a foreign business or an Indian business that may have issued you RSUs. So in that case, the treatment is very similar to securities if listed, right? What does that mean? If the company that you own ESOPs or RSUs for is a listed company, then you are essentially selling those on the exchanges, right? And security transaction tax is paid. So in that case, they'll be treated just like securities capital gains. However, if these are unlisted, right? A lot of startups haven't yet gone to IPO and they are unlisted. So in that case, the tax treatment would be very similar to debt instruments. It will be considered other capital gains. And you will have to consider 3 years as a holding period to determine long-term versus short-term. And the tax rates will be slab rate and 20% respectively. Now, hopefully, the treatment of some of the segments under which head they fall into and what tax rates are applicable is very clear to us. So let's move on to set off and carry forward losses. Now, this is something I don't like to talk about. Who likes to talk about losses, right? But it's very important part of it's an unavoidable part of trading in markets, right? Sometimes you have gains, sometimes you have losses. So how to treat losses? I mean, losses are very important to report. We get a lot of traders who feel that they've incurred losses and hence there is no need to report that trading activity. On the contrary, not reporting losses is the most common reason for you to get income tax notice, because in that case, income tax department is essentially saying you have capital to trade into markets. Then why are you not reporting or filing your income tax returns and reporting those sources of incomes, right? So a lot of people get confused in treatment of losses. So let's very quickly walk through it. So the first column is type of loss in the current year. The second column indicates the adjustment or set off of those losses and the rules around it. And the third column indicates just in case you were not able to set them off in the current year, why would you not be able to set it off? Just in case if you did not have any other income or gains against which you can set it off, then you have to carry it forward. It's a great provision under Income Tax Act where if you incurred losses, markets have cycles. And for example, if you incurred losses in a particular financial year and made gains in a consequent year, then you can carry forward those losses from previous financial years and set them off against gains from the current financial year. So those are the three columns. So let's very quickly go through it. So long-term capital losses can only be set off against other long-term capital gains. So capital gains is considered special rate income. Why? Because the rates are well defined. They are either 10% or 20% in case of long-term and 15% or slab rate in case of short-term. So the rates 10%, 15%, 20% are special rates, right? And that's why it's called special rate income. So special rate income can only be set off against other special rate incomes, right? So long-term capital losses can only be set off against other long-term capital gains. Just in case you did not have any other long-term capital gains. So what are we talking about here? You have just Zerodha demat account. You cannot have both gains and losses, right? This primarily applies to, if you have long-term capital losses from trading activity, right? Investing activity. However, you have long-term gains from selling other kind of capital assets, like if you sold a house property, then in that case, you can set off your losses from securities against gains from selling house property, right? So you can adjust them against other long-term gains, and you can carry them forward for up to 8 years. Now, short-term capital losses, on the contrary, can be set off against both short-term gains and long-term gains. Again, you can carry them forward for 8 years. Now, you may ask why this difference in treatment. So, short-term capital losses, essentially short-term income is taxed at a higher rate. So, what income tax department is saying is, I'm going to allow you to set those higher rate losses against both short-term capital gains, which is the same rate income, but also long-term capital gains, which is a lower rate income, right? However, in case of long-term capital losses, if you set them off against short-term capital losses, then it would essentially mean you are setting off lower rate losses against higher rate incomes, which is something income tax department does not like. It's very obvious. Non-speculative business losses. Remember, I told you futures and options are considered non-speculative business, reported under non-speculative business and profession income head, right? So any losses arising from buying and selling derivatives contract is considered non-speculative business losses, and they can be set off against any other income except salary. It's very obvious. You can't set off losses from business income against salary income, right? Those are two very different nature of incomes. So income tax department does not permit of setting off business losses against salary income. Again, you can carry them forward for up to 8 years. On the other hand, speculative business losses, which arise from intraday trading, can only be set off against other speculative business gains, and they can only be carried forward for up to 4 years. I think a lot of time people get confused between current year losses versus brought forward losses, right? So what are current year losses? These are the losses incurred during the previous financial year, right? For which you are reporting your incomes and filing your income tax return. So what are brought forward losses then? Brought forward losses are, as the name suggests, losses brought forward from previous financial years, right? So like we are seeing here, you are carrying forward these losses. So these losses will become brought forward losses in the next assessment year. So you can also, if you have incurred losses in the past financial year, you can bring them forward into current year and set them off against gains or incomes from this current year, right? However, you have to, very important rule to remember is brought forward losses can only be set off against the same income head. Now, this is something a lot of customers get confused about. It's primarily because they are losses from previous years, and for some reason income tax department does not allow them to be set off against other income heads. So now that we have talked about loss and loss treatment, let's move on to something called tax loss harvesting. Now, it's not very relevant right now. Right now is tax filing season. 31st July is the due date to file income tax returns. However, we get quite frequently asked about tax loss harvesting, what it is, and how can traders and investors can take advantage of it. Tax loss harvesting is essentially practice of realizing losses by selling loss-making shares in mutual funds before the end of the financial year. These losses can then be set off against realized gains, hence optimizing the tax liability, right? Essentially what we are saying is, I think the best way to talk about it is looking at this Zerodha console screenshots and walk you through the example, right? So this is a great feature that Zerodha console provides, where you can navigate to, I hope you are all familiar with Zerodha console. You can, by logging into Kite, you can go to your console. Console is essentially Zerodha's reporting platform, where you can visualize your portfolio, download tax P&L reports and other kind of reports. Also, you can take advantage of tax loss harvesting. So, like you can see here, in this particular instance, we have a realized short-term gains of 59 rupees. We have unrealized. What is realized versus unrealized? Realized means you have already liquidated this position. that means it's realized. The gains or losses from that position is already realized. However, unrealized means you are still holding these positions, but based on the market value, right? Based on MTM, these are the either gains or losses for that particular position. So in this case, I have 13.93k losses, unrealized losses, which are short-term losses. On the other hand, I don't have any long-term gains, and I have some long-term losses, unrealized long-term losses, which is 2.48k. Now down here it's just showing you breakdown of the summary information across different segments, right? So we're not going to talk about it, but what's important is this number to remember. So what Zerodha folks here are suggesting is if you sell some of these positions, right, where you have unrealized losses, if you liquidate some of these positions and you realize those losses, then you can go and set them off against these gains from current year, right? However, gains are negligible here, so you won't see a huge impact on your tax liability. But think about if we had, instead of 59 rupees, 59,000 rupees ka gains, right? So by liquidating these positions, you can set off these losses. Remember, we talked about loss and their treatment in the previous slide. So you can liquidate those positions and set off those losses against the gains. Hypothetically, let's say it's 59,000. So now after setting off almost 14,000 ka losses, now your taxable income would be 45,000 instead of 59,000, right? And that means you save taxes on almost 14,000 rupees worth of income, right? Let's say this is long-term capital gains, and let's say these are all listed securities, which they are in case of Zerodha. Then the tax rate is 10%, right? And hence you would end up saving almost on 14,000, 10% is 1,400 rupees. You will end up saving 1,400 rupees, right? We've seen in a lot of cases, traders, investors who really smartly take advantage of tax loss harvesting can save lakhs of rupees in taxes. Now, this is in Western markets, this activity is called something called wash sale. It's not strictly allowed. The tax authorities like IRS and US strictly advises against it, and there is a rule of 30-day cooling off period, right? So if you sell and buy a position in 30 days, then you cannot take advantage of those losses, right? However, in India there is no such rule, and it's an acceptable practice to essentially realize your unrealized losses and set them off against gains to save some taxes, right? However, in your particular income situation, take the advice from a chartered accountant, or you can also come onto our platform, and we have some amazing chartered accountants who can guide and advise you on the same topic. All right. So that's tax loss harvesting. I think we already have done a webinar on tax loss harvesting, and you will find the link below in the description. What we'll also do is, as we get closer to end of financial year, which is 31st March next year, we'll again do a video with a little more details. We have cool features coming out on Quicko.com. So we'll do another video where we'll talk in depth about tax loss harvesting. So for now, I think Zerodha has this amazing feature where you can gift shares to your loved ones, to your friends, to your colleagues. And we oftentimes get asked this question: what's the tax treatment of gifting of shares, right? It's a noble gesture, but at the same time, you want to be making sure that you take maximum advantage of gifting or donating, right? Because you don't want to be paying taxes on them. So what are the rules around tax on gifting shares? Let's go through it again. So if the gift amount, right, if the gift amount is less than 50,000 rupees, how do you determine it? Here you are gifting shares, so essentially you have to look at the market value. And if the market value, combined market value of all the shares that you're gifting is less than 50,000 rupees, then it is not taxable for sender, but it's also exempt income for receiver, right? So receiver also does not have to pay any taxes on when they receive those shares in form of gift. Now, let's say if the total market values of shares you are gifting is greater than 50,000 rupees, again, it's not taxable for sender. So it's not taxable for sender in either case, right? Whether it is less than 50,000 rupees or greater than 50,000 rupees, because sender is the one who is gifting this shares. So there is no tax burden on the sender. However, in case of receiver, if the amount is greater than 50,000 rupees, It's only exempt if the sender is a blood relative, right? Who is blood relative? Your parents, your siblings, your children, right? And income tax department also has an exception of your spouse, right? So it's exempt income only if you receive it from blood relatives. Now, what if you receive it from friends, right? On wedding or other occasions, if you receive a gift of shares from an unrelated person, right? Then in that case, it will be taxable under income from other sources. And income from other sources are taxed at slab rate, right? So just like salary income. Now, you may ask that in case of blood relatives, the income is completely exempt. What does that mean? So it's only the receipt of shares is not taxable, right? However, if you sell those shares after receiving them, right? So let's say you are the receiver and your parents are sender, right? So when you receive those shares, no matter what the amount is, they are not taxable. However, when you sell those shares, is when there'll be tax applicability. Now, how will you be taxed? Essentially, you will be taxed under capital gains head, and your cost of acquisition would be the purchase price, the original purchase price, right? So whenever your parents purchase those shares would be essentially the cost of acquisition, and the cost of and the sales proceeds which essentially be calculated depending on the day you sell those shares on the exchanges in the market, right? So remember, it's completely tax exempt to receive those shares in form of gift from your blood relatives. However, they are taxable when you sell them off on the markets, on exchanges or otherwise, right? And they are taxed as capital gains. Now, depending on holding period, those same rules apply, whether it is less than 1 year, more than 1 year, depending on that, you will have to bear the tax liability or the tax burden. Cool. I hope gifting of shares is clear to everyone. Let's now move on to tax documents. So this first segment was broadly covering taxes on investing and trading. I hope you all understood the tax treatment of investing into capital markets, trading into capital markets. Then we talk about losses, both current year losses, loss adjustments, and we talk about brought forward losses. We talked about tax loss harvesting, and we talked about in the last slide gifting of shares, right? So I hope those topics are covered. In this next segment, we're going to talk about different tax documents. Awesome. So in the second part of video, we're going to talk about different tax documents, right? Why? Some of you maybe this is your first year filing your income tax return, starting a new job. For some of you, it may be a refresher, right? These are the most common tax documents for anybody who is investing into stock markets to understand and know of. Let's first start with Form 16. So Form 16 is essentially your tax credit statement, right? Let's understand it by looking at a sample Form 16. So Form 16 essentially has two parts, Part A and Part B. So let's first look at Part A. So I have a Form 16 here, a Form 16 Part A here to be precise. So Form 16 Part A, like I said, is a tax credit statement. It has information about your employer. It has your information. It has PAN and TAN of the employer. Deductor essentially is employer, and it also has your PAN information here. It also very clearly indicates what assessment year, right? So what is the year this Form 16 issued for, and it talks about the period with employer, right? So if you change jobs, you will see that the period here you will essentially have a shorter period than the entire financial year. Down here you can see all the tax credits. Employers have to file TDS return every quarter and deposit the TDS, so which is what you are seeing here. So every quarter, what amount was paid, credited to me, and what was the TDS withheld, and these are the total TDS credits. Down here you could see all every monthly whenever I got salary, I got salary and whatever TDS deductions were made. So this is essentially the month-wise breakdown of the quarterly data that we saw up here. So this is part A. This is issued by employers to employee by 15th of June every financial year. So if you haven't received your Form 16 from your employer, you need to ask for Form 16. If your employer does not issue Form 16, don't worry, no need to panic. You could still file your income tax return. We're going to talk about it in the third and the last section as to how to file your return. Let's also take a look at Part B. Now, unlike Part A, Part B is a breakdown of salary, right? So it's also issued by employer. Most employers issue Part A and Part B in a combined PDF. Sometimes you may also get two separate PDFs like I do here. Again, it has repetition of same information: employer details, employee details, employer PAN and TIN, employee PAN, assessment, etc. I think let's focus on the most important thing. So it indicates here that I haven't opted into the new regime. We have done another video talking about a new regime and old regime and what are the advantages and disadvantages of opting for either. So please find a link below in description. So as you can see here, it contains the salary breakdown. So you can see gross salary, which is essentially a culmination of basic salary plus any perquisites, any bonuses issued. It will also include all the allowances, right? Taxable and non-taxable allowances. Such as HRA, if you got LTA, leave travel allowance, all those allowances constitute part of your salary, gross salary. Down here you would see deductions under section 16. So these are essentially your professional tax, if entertainment allowance was deducted if you're a government employee, and the standard deduction of 50,000 rupees, right? So starting from last financial year, salaried employees get additional 50,000 rupees deduction under section 16 IA. So essentially you can you can derive the taxable salary income, which is what you would pay tax on from your Form 16, right? A lot of people use Form 16 to file their income tax return. A lot of chartered accountants also ask for Form 16 to file their income tax return. I'll also show you how to use it on Quicko. The most important part that Form 16 has, along with your tax credits and salary breakdown, is the deductions, right? If you disclose any deductions to your employer, what are deductions? These are essentially tax deductible investments, like if there is a PF deduction happening at your workplace, or you purchase a medical insurance for yourself, your family, or your parents. You may be you may have purchased a life insurance policy, right? And you may be paying premiums for the same. So there are all kind of deductions under Chapter 6A, and you would see those deductions listed here. Now, why are these deductions here? Because you disclose these deductions to your employer in form of in Form 12BB or through your HRMS platform, right? So your employer used this information to calculate your TDS and deposit it with Income Tax Department. So this is Form 16. Let's go back here. So like I said, it's a TDS certificate on salary issued by employer. The employer issues Form 16 by 15th of June every assessment year. Let's quickly move on to Form 26AS. So now Form 26AS is your essentially complete tax credit statement, right? So Form 16 only has information about your salary and any TDS deducted on your salary, while Form 26AS has all tax credits. Any TDS deducted on any income sources is listed in Form 26AS, along with if you paid advance tax or self-assessment tax, you would also see that in your Form 26AS. So this is by far the most important document, and you are not dependent on anyone. You can simply download Form 26AS from your income tax account by logging into income tax portal. So let's very quickly walk through it. It has my PAN, name, and my address information, along with financial year and assessment year, like all the tax documents do. And then, as you can start seeing here, it has information about taxes deducted at source, right? So this is my salary TDS. I'm seeing the credit amount along with all the TDS deductions. I can also see the deductor information. In this case, because it's salary, it would be my employer. As I scroll down, I'll also see TDS on dividend, for instance, under section 194. So a lot of you are investing in trading, so you must have received dividend. And since last financial year again, the dividend distribution tax was abolished, and instead dividend became taxable in the hand of taxpayer, receiver. The TDS is deducted under section 194, usually by either the company who is paying out dividends or AMCs in case of mutual funds. So you would see information of all kind of TDS. Further scrolling down, you would see details of taxes paid, right? So if you paid any taxes using BS, using TIN NSDL website, or you can now also pay taxes on Quicko. So if you paid taxes yourself, like advance tax, right? There are 4 quarterly installments of advance tax. So if you paid advance tax, you would see the information here in form of the BSR code and Chalan number, which are the most important thing, and then also the details of taxes paid by you. Now we have a really good tool on Quicko which helps you calculate advance taxes on your capital gains and your business profession income arising out of intraday and FNO. So do take advantage of it. I'll also show it to you in the later half of this video. So further scrolling through Form 26AS. Form 26AS essentially, like I said, will have all kind of tax credits in against your PAN. So whether it was tax deducted by a deductor, or whether it was taxes paid by you, or in case you purchase car or any expensive jewelry, or wherever TCS was collected, right? That also would reflect in your Form 26AS. Please don't forget to claim your tax credits when you file your income tax returns. You could potentially get a refund if your tax credits are higher than your tax liability. So don't miss out on that money. And always keep Form 26AS handy. It always is a good practice. So let's go back here. So we've already talked about Form 26AS. We can move on to annual information statement. Right now, there are too many text documents here, but each one of them have a unique purpose, and they're very simple to understand. If you like we said, Form 16 is a tax credit statement issued by employer to employees and mostly contains information about your salary. Form 26AS is a complete tax credit statement. It has all forms of tax credits against your PAN, be it from salary or any other income sources, along with TCS and any taxes paid by you. Now, what is annual information statement? This is something Income Tax Department has started doing recently, and it's really amazing how far we have come in India, right? With digital transformation in government and governance, we now see that a lot of government departments talking to each other, right? Sharing data with each other. Mostly Aadhaar and all the transformation that came around Aadhaar has enabled departments to share data, right? Because there is now one identity. So if you're trading into stock markets, there is understanding between Income Tax Department and SEBI, which is the regulator of capital markets in India, to exchange data, right? So if you're trading into markets, your exchanges or your brokerages are reporting data to Income Tax Department about your trading activity. Also, if you are working, of course, your employers are filing TDS return and hence letting know Income Tax Department about your. Also, when you travel or you purchase, expensive items like cars or luxury goods, all of that information gets reported back to Income Tax Department. Nothing to worry about. I mean, if you are a noble citizen and you pay your taxes on time, this is nothing to worry about. In fact, some of these documents are summary of your financial year and everything you did. So let's talk about annual information statement by looking at one. So how is it different than Form 16 and Form 26AS? So annual information statement is essentially a summary of all financial transactions done by you in a given financial year, right? So what constitutes financial transaction, right? So things like you buying and selling stocks, buying and selling properties, right, are some classic examples of specified financial transaction. Also, your salary information comes into annual information statement. If any dividend was paid by companies or AMCs to you, that information will reflect in annual information statement. So annual information statement is little different than Form 26AS. Form 26AS has information about all your tax credits, which AIS, by the way, also has, but over and above, it has information about all financial transactions, right? So let's very quickly scroll through an AIS statement. So like you can see here, it has information about my salary. It also has information about all the dividend that I received. If you sold any shares in given financial year, previous financial year, then you would also see that information in your annual information statement, right? So like I said, through SEBI or exchanges, your data is getting reported to Income Tax Department, and Income Tax Department is populating it into your annual information statement. Now you may ask, how is this annual information statement helpful to you? So this usually is a great document to keep handy when you are filing your income tax return. On Quicko, we don't expect you to punch in information from the statement, but rather we allow you to import it from your annual information statement by either uploading the PDF or connecting your income tax account, and we can import data directly from, right? So you don't have to worry about any of it. However, it's again a great document to always keep handy and understand. So it will also have information about any purchase or sale of shares. So let's see if we can find it, right? So there we go. Like you can see, sale of securities and unit of mutual funds, right? So so annual information statement again has all the specified financial transactions, everything we talked about. Now let's talk about capital gain statements. So capital gain statements are usually issued by your broker. It reflects any proceeds from sale of stocks, mutual funds, etc. You can download capital gain statements usually from your broker platform, AMC, or you can, if you are only investing in mutual funds, then you can also download it from CAMS and Carvies, who are a centralized repository of all folios and all mutual fund related data. Trading P&L. Trading P&L is very similar to capital gain statement. However, while capital gain statement only has information about sale of shares and mutual funds, trading P&L has trade-wise or script-wise P&L for stocks, mutual funds, ETFs, but also intraday and F&O segments, right? So it's essentially de facto document mostly generated by your broker. So you can log into Zerodha console and download your trading P&L by going to report section. What else does it have apart from the P&L? It also has all the transfer expenses. Remember, when you trade in markets, there are all kind of different transfer expenses. Your broker may charge brokerage. There's security transaction tax, stamp duty is paid. Also, there are exchange transaction fees, right? There may be legal fees, annual maintenance charges, etc. So you could claim all those expenses in your income tax return and reduce your taxable income. So trading P&L, again, you can download from your broker. So don't forget to download your trading P&L statement. Now, this is the most debated thing, right? Why does my P&L not match with my AIS, right? I have downloaded my trading P&L statement from my broker, from Zerodha console, and it does not match with AIS. For that, we looked at both AIS and trading P&L, but let's look the fundamental differences between two, right? So AIS is generated by Income Tax Department using inputs provided by depositories, property registrars, exchanges, AMCs, etc. Right? So Income Tax Department itself does not generate data, but it uses data provided by all these other government bodies or non-governmental bodies. Trading P&L, on the other hand, is generated by brokers using trades placed on the broker system, right? So any buy or sell transactions that you have placed on any a given broker, that data is used. It's essentially called a trade book. So trade book is used to generate the trading P&L. So AIS includes specified financial transactions for given financial year, like we already looked at. On the other hand, trading P&L includes trade-wise and script-wise P&L for trades placed during a particular period, right? So you can download your trading P&L for a quarter, for a day, or you can also download it for a financial year, right? So that's the fundamental difference between AIS. So AIS will only cover financial transaction for given financial year. Now, capital gains are calculated basis contract notes reported by exchanges. In case of trading P&L, capital gains are calculated basis trades placed in broker system, right? So it's logical that trading P&L is going to be more accurate, right? Because it essentially it's calculated by the system where you have done these transactions, where you place these trades, so it can more accurately calculate this information. On the other hand, AIS is essentially generated using information sourced from all these other government and non-government bodies, and how much ever we do not like, some of those systems are not fully connected yet. Not all the data flows through the systems. Also, there can be a lot of historical data, right? So if the system got put in place last financial year or year before that, then what happens to all the data before that, right? So however, it's a great document. I think Income Tax Department has made strides in terms of populating information into your AIS, and we really look forward to this becoming a de facto document for taxpayers, where essentially filing of an income tax return would just be verifying your AIS and e-verifying it somehow, right? Of course, it would be difficult for our business because we help people file income tax return. But I mean, when we founded Quicko, our goal was to simplify taxes. And if it does get simplified by some document that Income Tax Department generates, then we are all game for it, because we think we can add a lot more value than just sourcing your data from different sources. The last and final point doesn't include P&L from intraday and F&O, right? Now, why is that? Your capital gains, your purchase and sale of shares in mutual funds are reported by exchanges to Income Tax Department. However, up until now, we haven't seen intraday and F&O transactions completely being reported to Income Tax Department and reflecting an annual information statement. So there might be some gaps there as well. On the other hand, trading P&L mostly includes intraday and F&O segments. Now, this being said, we are not saying one is better than the other. What we are saying is a lot of places we have seen that broker P&L does not have all the information, does not cover all these segments, or may miss out on certain nuances around taxation, right? So you should always seek advice from chartered accountants, a qualified tax professional, or you can also use an online platform like Quicko. However, what we have generally seen that at this point, like brokers like Zerodha has really invested a lot of money in their tech in generating trading P&L. Me and my team also work closely with Zerodha team on kind of exchanging thoughts and ideas and our knowledge around income tax compliances and tax treatment, and we are continuously striving towards improving this trading P&L statements. So what you can do is compare trading P&L and AIS and see which is the best document to report your capital gains and intraday and F&O activity into your income tax return. Now, last but not the least, income tax return forms, right? So there are essentially forms in which you report your income, also called ITR forms. So there are essentially 4 ITR forms that you need to care about as an individual taxpayer, which are ITR 1, 2, 3 and 4. So ITR 1 covers income from salary. It covers one house property and other income sources like savings interest, FD interest, dividend income, etc. ITR 2 covers capital gains plus everything that's covered under form ITR 1. So that means that makes ITR 2 the most important like income tax return form for people who are investing into mutual funds or doing delivery trading, right? ITR 3 covers income from business and profession. Remember, intraday and F&O is considered business profession income. So if you are doing intraday and F&O trading, you will have to file ITR 3. It also covers all the other income heads and financial situations that's covered under ITR 1, 2, and 4. ITR 4 is a simpler income tax return for small businesses or small proprietors who want to take advantage of something called presumptive taxation scheme, where you can instead of maintaining books of accounts and getting your books audited, what you can do is claim 6% of your turnover as your profit, at least 6% as profit, or actual profit, whichever is higher, and take advantage of presumptive taxation scheme and not having to get your books of accounts audited. Now, a lot of traders, investor friends ask us whether they can take advantage of presumptive taxation scheme, and they absolutely can. However, there are a few caveats. Once you opt in, you can only opt out once. And you cannot opt into presumptive taxation scheme if you have opted out in previous 5 financial years, right? So keep that in mind. The other thing about presumptive taxation scheme is that you will not be able to, because you have to report at least 6% profit, you will not be able to either set off or carry forward your losses. So very important thing to keep in mind if you are a trader investor. Now these are all the tax documents. Let's very quickly, I missed to show you Zerodha tax P&L report. So let's very quickly take a look at Zerodha tax P&L report. So here is a sample Zerodha tax P&L report. So it's a little different because I'm on Mac. It might look a little different if you open it on a Windows machine. But essentially Zerodha tax P&L statement you can download from Zerodha console. And it has a summary of your entire trading activity for given financial year or given period. In this case, it's for the previous financial year, for which I'm going to show you how to file your income tax return. So this is the summary. You can also see all the different segments. So equity, mutual funds, F&O, currency and commodity, etc. Right? Let's just very quickly take a look at equity tabs. So you can see that there is the period for which this report is generated and the account details. The top section here is summary. It shows any short-term or long-term profits or losses, gains or losses. It also shows any intraday speculative profits or losses, and all the transfer expenses, right? The breakdown of transfer expenses charged by Zerodha. And down here you would see your script-wise data, right? So your script-wise P&L is down below. So I hope you are familiar with all the different text documents now, and you can confidently navigate around when somebody asks a Form 16 or Form 26 AS or AIS. In the description below, you will find instructions as to how you can download these documents from your income tax account in the interest of time. Otherwise, this video would be very long. So please do check those out. Now let's move on to tax audit, right? Tax audit is a pain point for a lot of investor traders. They are not sure as to what is tax audit, whether they should get their books of accounts audited or not. And there's a lot of confusion. Different people give different advice, right? So we usually follow this general rule of thumb. This table here very nicely prescribes when tax audit is applicable. This is just our opinion. A chartered accountant or another tax expert may advise you differently. So I would request you to seek advice from a professional. But when you use Quicko, this is the usual guidelines that we follow. I mean, we feel we believe that prevention is better than cure. So rather than receive a notice, we would err on side of caution. So as you can see here, tax audit is applicable when you have incurred losses, right? So irrespective of turnover, when you have incurred losses, and if your income is above your taxable income is above basic exemption, then generally it's a good advice to get your books of accounts audited, because income tax department is saying that you have other income sources, you have taxable income, however you are reporting losses in your business and profession. So please get your books of accounts audited by a chartered accountant, right? Now there's a lot of discussion and debate around what are the thresholds and what are the different conditions. So I'm also going to shed some light on it, but let's very quickly walk through this. So under tax audit, a practicing chartered accountant examines and reviews your books of accounts and submits the tax audit report to the income tax department. The general conditions of tax audit applicability is if your turnover exceeds INR 10 crore, right? So there's a turnover threshold. Or if your profits are less than 6% of turnover. So now this means either your profits are less than 6% of turnover or you have incurred losses. Or along with, you have to read this condition with N. So profit is less than 6% of turnover and you have opted out of presumptive taxation scheme in any of the previous 5 financial year. Along with, of course, like I said, if your taxable income is above basic exemption, right? So these are the general guidelines when you should get your books of accounts audited. Now, what we do on Quicko is we have a recommendation engine. Looking at your data, we recommend whether tax audit is applicable or not. Now, it's always up to taxpayer whether they want to get their books of accounts audited or not. Also, Quicko is an online tax filing platform. We are a technology platform. We are not CA firm. So we cannot technically get your books of accounts audited, right? So what you will have to do is if you use our platform to file your return, you will have to find chartered accountant either within our network or outside of our network who would then audit your books of accounts and submit your audit reports. Now, there was a tweet from Nitin last year where Nitin, he always talks about the rights and the best interest of traders and investors. And one of the things that Nitin and I have several times discussed is this draconian requirement of getting books of accounts audited for investors and traders, right? Some of you are really young, investing, trading for the first time. You mostly trade through demat accounts. You deposit money or withdraw money using bank transactions, right? Net banking, UPI or otherwise. So these are mostly digital transaction. And most of this data is anyhow reported to exchanges, and like we saw in annual information statement, a lot of this data flows back to income tax department. So we've always been of an opinion that the tax audit requirement for people purely investing in trading in market is little of an outreach. And past couple of years, we've seen some improvement in that direction, right? The audit turnover requirements were increased from first 2 crore, then to 5 crore, and now it stands at 10 crore. However, the way turnover is calculated in case of certain trading activity, you could easily have a turnover of in excess of 10 crore with a very small capital, right? So, however, the reality of the day is that tax audit is applicable to investors and traders. And what Nitin here is indicating is that same opinion that it would be great if finance minister, income tax department in general reconsiders tax audit applicability rules, especially people investing in stock markets, right? Because it demotivates people. It's an additional compliance burden. And a lot of time it's also very expensive to get your books of accounts audited, because somebody will have to spend time and sift through your financial transactions, your bank statements, your trading statements before they can certify your books of accounts. Now there was a lot of feedback on this particular tweet, and a lot of people said that both Nitin and Quicko are like loosely prescribing tax audit guidelines. And we wrote a really beautiful blog back then. Sakshi, who is a senior chartered accountant at Quicko, wrote this blog. And like I said, guys, we don't want tax audit for investors and traders. Hopefully it goes away, right? For the reasons I already mentioned. However, the reality today is we've seen that even when your turnover is less than 1 crore, even when there are nominal losses of 1 lakh or 2 lakh, we've seen taxpayers later receiving notices from income tax department, right? There are few examples here on my screen here. So one thing is this income tax department utility. I don't know if you can see, but later you can pause and zoom in. What it says here is it here indicates that because your turnover is less than the profits that you have reported is less than 6% of your turnover, and you haven't filled the financial statements like your balance sheet and P&L, and you haven't added auditor details, you may receive income tax notice, right? There is a clear validation rule that you can see here. Also, here is a snippet from a notice, text notice, right? This is something we had shared last year as well. This is one of the notices one of our customers received who had incomes above basic exemption limit, but the turnover did not exceed 1 crore and had incurred nominal losses and did not get their books of accounts audited. And we later heard back from customer that he had received this notice from income tax department asking him to furnish his financial statements, revise his ITR and report, his balance sheet and P&L, also get his books of accounts audited by a chartered accountant, right? So rather than confusing you or, fear mongering, what essentially we are talking about is, get the expert advice, be it from your chartered accountant or, you can use Quicko and our recommendation engine will show you, and use your best judgment in case of whether you would want to get your books of accounts audited or not. So I think that wraps the second part of this presentation. In the third part of this presentation, I want to very quickly walk you through Quicko and how you can file your income tax returns on Quicko. So stay tuned. In this third part, we're going to learn how to file your income tax return using Quicko. So you can start in two simple ways. If you are an existing Zerodha customer, you can log into console and you will see that there is a call to action to start your income tax filing journey. Alternatively, you can also go to zerodha.quicko.com and get started by clicking on this call to action here. Right. For this video, I'm going to start from console. So let me go and click on get started. I'm going to log into my Zerodha account. So what's happening here is you're giving Quicko consent to access your Zerodha account. So I'm going to click on continue. So when that happens, you automatically get onboarded onto Quicko. So you don't have to open an account on Quicko. And you have also granted Quicko access to your Zerodha demat account. This allows Quicko app to read your profile information, such as your demat account details, your email address, etc. Also, Quicko app can access your P&L data, right? So let's go ahead and enter PAN. Great. So once you enter PAN, click on get started. So PAN is permanent account number. That's a unique identifier issued by income tax department to all the taxpayers. So as soon as you enter PAN, Quicko automatically identifies you and shows you your first name, middle name, last name. Now this is very important. When you furnish your income tax return, you have to report first name, middle name, last name as per your PAN. So make sure this information is accurate. And if it is, then you can simply click on yes, that's me. So let's do that. Now, as soon as you have set up your taxpayer profile, you would land on Quicko dashboard. So there are a few simple parts to Quicko dashboard. Home is where you can see different CTAs. planning during the financial year. You can visualize your tax P&L, you can download your tax P&L, you can calculate a tax liability under new regime versus old regime. You can invest into tax saving mutual funds using Zerodha coin. You can calculate advanced tax on your trading or investing activity, and you can also take advantage of tax loss harvesting. Right now we're going to stay focused on filing because 31st July is the due date. So I'm going to click on start my income tax return, and there are two options. Option one, I can import data from income tax department, which is recommended because most of your income tax return will be auto-filled, and all you have to do is review and add any missing information. It drastically simplifies tax filing journey. Alternatively, you can also do it yourself, which means you can type it in manually. So for now, I'm going to choose import from ITD. Now, when you choose import from ITD option, you will have to authorize Quicko again to connect to your income tax account. I'm going to use Aadhaar OTP on Aadhaar registered mobile number. So let's click proceed. Now, you should have received an OTP on your Aadhaar registered mobile number. So let's go ahead and enter it. So once you have entered OTP received on your Aadhaar registered mobile number, let's click on verify. So what's happening right now is Quicko is connecting to your income tax account, and now as you can see, it's pre-filling information from income tax department, right? So right after it pre-fills information, we land inside your income tax return, and as you can see, Quicko has already pre-filled some information. So in this case, I'm using my account, so it has already imported my salary from my employer. Let's see if I have any other income sources. Let's go to other sources. So as you can see, I received some dividend as well, and I've received dividend. Dividend income is also already imported into my income tax return. I don't have any house property, so there is no house property income imported. Capital gains and business profession income. So we're gonna import capital gains from our Zerodha Demat account. So let's let's go ahead and do that. So once you're on capital gains, as you can see, our customers really love our product because we are integrated into all the major brokerage houses in India, right? So you can simply by authorizing or giving consent, you can connect your Quicko account to your broker and easily import your P&L into your income tax return. Now think about it, this would require you sifting through logging into your broker, sifting through different reports and downloading the correct report, then providing it to your chartered accountant, or otherwise, entering all the data manually into government utilities or on some other platforms. What you can do on Quicko is simply import all of that in a snap. So let's go ahead and see that. So you have three different options. You can import from broker, you can import using template, or else you can also add trades manually. So for this demo, we're gonna import data from our Zerodha Demat account. So let's click on import from broker. You will see all the brokers that we are integrated with here. Let's go ahead and import data from our Zerodha Demat account. Let's click continue. So again, it's gonna ask for consent. Once you give consent, now Quicko can access your P&L information from Zerodha Demat account. So here we are importing your P&L from your Zerodha Demat account. So let's wait. So what did we do here? We essentially connected with your Zerodha Demat account, and for the year that you are filing return, so assessment year 22-23, for the duration, we're gonna go and import P&L from your Zerodha Demat account. We're gonna import your equity trades, your mutual fund, ETF trades. We're also gonna import your commodities and currency futures and options trades. So all of that data is imported. All the segments are covered. So let's go ahead and see what data we have imported here. So as you can see, my Zerodha Demat account is connected here. I have in my account done very negligible trading, but we see a lot of time traders who have tens of thousands of trades, if not hundreds of thousands of trade, active traders, daily traders. they really love our product because all those hundreds of thousands of trades can be imported into Quicko's platform in a snap. So you can see Quicko has nicely categorized all your capital gains across different segments. Shares, ESOPs, RSUs, mutual funds, bonds, debentures, and debt, MF and ETF. And down below here, you can see all your transactions, securities transactions. So any scripts you purchased and sold during the given financial year would be reflected here. Let's also see whether our intraday and F&O trades are imported. So like you can see here, Quicko has already created your Zerodha trading account and imported your intraday and F&O trades as well. So remember in the first half we discussed that intraday and F&O trades are reported as business profession income, and specifically intraday is reported as speculative business income, and F&O trading is reported as non-speculative business income. So let's see if we can verify that. So like you can see here, Quicko has already imported my F&O turnover and any losses incurred or profits that I've made on F&O trading. Also down below here you can see speculative income. That means any intraday turnover and intraday profit or losses I may have. What's really awesome is Quicko also automatically imports all your transfer expenses from your Zerodha Demat account, right? So any brokerage charges, any interest fees charged, exchange turnover fees, stamp duty, any GST, right? So taxes also are automatically imported. So all the expenses are automatically imported. A lot of time traders, investors don't really know that they can, by claiming all these expenses, they can reduce their tax liability. So apart from your Demat account related charges, if there are any other expenses, for example, you purchased a new laptop in order to do trading activity, you can claim depreciation expense. If you have taken internet connection or you are paying utility bills, right? So all of those expenses are deductible from your business and profession income. So don't forget to take advantage of it or seek an expert help. So let's go back. So when you are reporting your business profession income, you have to keep two things in mind. You will have to report your financial statements. Your financial statements are nothing but your profit and loss statement and your balance sheet statement, right? So what is profit and loss statement? Profit and loss statement is essentially all your incomes and all your expenses. So in this case, because I had incurred losses, you can see on expenses side, I have lost from business and profession income, and all other transfer expenses are also accounted for. In the balance sheet is essentially summary of your business related assets and liabilities. So in this particular case, because our business is Demat account, our business is trading conducted through a Demat account, what Quicko automatically does is it imports your balance with broker as your current asset, and it also considers it to be a proprietor's capital, right, in the liabilities. Let's see how you can modify that. So you can simply go to assets. Like you can see here, we have imported balance with broker. But if you have any other balances, right, you have bank balances related to this trading activity. If you've loaned money to someone, you can also add it here. Any kind of stock and inventory, any kind of fixed asset, right? Remember we talked about having laptop, land or building that you are using for business professional income purposes can also be claimed as your assets here. On the liability side, like we discussed, we report most of your assets are essentially purchased through proprietor's capital. But just in case that's not true, you can always go and modify this information. So we get a lot of young traders, investors who have borrowed money from family, relatives, friends, right? So you can disclose those as liabilities on your trading business and profession. You can enter that information here. So see folks how simple it is to import your Zerodha Demat account. You can also import trades from other Demat accounts. In my case, since I only have Zerodha account, I'll go ahead and try to file my income tax return. So let's go to tax breaks. Tax breaks are essentially deductions. These are investments that you make, insurance premiums you pay, or any educational expenses and things like that. So you can claim those as tax deductions. What do tax deductions do? They help you reduce your tax liability by reducing your taxable income. So in my case, all the deductions are automatically imported because I connected my Quicko account with my income tax account. So my deductions are automatically imported from my Form 16. Let's go to tax credits. Again, the same story here. So tax credits essentially are all the taxes deducted by employer, or if you are freelancing or consulting, then whoever is making payment may have deducted TDS. So all your TDS credits are automatically imported into your income tax return along with any taxes paid by you. So if you paid self-assessment tax or advance tax, then that shall also reflect in your income tax return. So you may ask, why didn't I have to upload my Form 16 or my Form 26AS? That's because folks here at Quicko have built these awesome features where you can integrate your Quicko account with your income tax account, and we pretty much read all that information from your income tax account, so that you don't have to manually type it in, or sift through documents and upload those documents onto our platform. So that's pretty cool. My bank account is automatically imported. So for a lot of traders and investors who've been trading year over year, you may have losses from previous years. Remember in the first part we talked about current year losses and brought forward losses. So if you have current year losses, don't sweat. When we read your P&L data from your Zerodha account, we automatically take care of your current year losses and adjust them against any other income. But just in case you had incurred losses in previous years, what you can do is you can also click on brought forward losses here and directly pre-fill it from your previous year's ITR. In my case, since I just started trading like a lot of you, I don't have any carry forward or brought forward losses from previous years, so I won't be able to pre-fill that information. So let's review the income tax return. So once you click on review, you see 3 tabs here: tax computation, new versus old regime, and tax audit. Let's walk through each one of them. So tax computation essentially shows me if I'm getting a refund or there's a tax liability. If there's a tax liability, I'll have to pay it before I can file my return. And it shows me the breakdown of my tax computation, right? So all the taxable incomes, any deductions, any current year losses that got adjusted, and finally it arrives at my gross total income. After chapter 6A deductions arrives at my total taxable income. So now this is the amount on which your taxes will be calculated. So in my case, there are 24,742 rupees worth of taxes to be paid. However, there was a lot of TDS deducted from my employer. So let's see if that's accounted for. So as you can see here, there is 26,086 rupees worth of tax credits, and hence I'm in fact entitled to some refund. Hopefully I'll go and spend this money. It's also prompting me here that I need to add a refund bank account. Now, what is a refund bank account? This is a bank account in which income tax department will deposit your refund. So although my bank account is imported, it's still not marked as refund account. So let's go ahead and mark it as refund account. Now, a lot of people ask us question if they need to disclose all the bank accounts. It's completely up to you. Ideally, you should disclose all the active bank accounts to income tax department in your income tax return. But in my case, there's only one bank account. So let me go back to filing. And again, go back to, so new versus old regime is a recommendation engine looking at your income situation. It recommends which is the more preferable regime. Because I have already chosen old regime, it's showing me that that's the chosen regime plus that's the recommended regime, because I tend to gain about 25,000 rupees worth of tax saving by opting for old regime. Just in case you want to change this preference, you can simply click on change my preference, and you can change the tax regime from here. Tax audit. Folks, in the earlier part, we talked about tax audit and applicability of tax audit. So as you can see here, in my case, my turnover is around 18 lakh, and there are losses worth 90,000 rupees. and because my income is above basic exemption limit, Quicko is recommending me a tax audit. Now this is completely up to me. If I want to, if I do not wish to get my books of accounts audited, I can still file my income tax returns. But just in case, I mean, Quicko is recommending tax audit. You can find a chartered accountant offline, or you can also tap into one of the chartered accountants in our network who can help you audit your books of accounts. I'm gonna opt out of the audit for time being. So I'm going to be opting out of tax audit for the time being. Let's go ahead and save this preference. So I'll be opting out of tax audit for the purposes of this demo. So let's go ahead and set that preference. So right here, it's asking me if I want to opt into tax audit. I'll say no and save my preference. Well, so I think I'm ready to file my income tax return. But before you can file your income tax return, Quicko runs hundreds of checks against income tax department validation rules, right? So these are rules defined so that you can do accurate filing. So let's see, there's some discrepancy in my salary income. I'll go and verify it. So it says my employer address is not pre-filled. Let's fix that. And there we go. So as soon as I fixed the errors it prompted, it's now allowing me to file my income tax return. All the information about my profile, tax computation is mentioned here. I can also download ITR JSON just for my references. However, I can very easily e-file my income tax return. So let's go ahead and file our income tax return. It prompts me with the most important information, which ITR form is being filed. Because I have business profession income, it's filing ITR 3. I'm opting for old regime. I am also filing return for nth number of times this assessment year, which is why it's automatically picking up that it's going to be a revised return. So let's go ahead and confirm. And now it's submitting my income tax return to income tax department. So folks, that's how easy it is to file your income tax return on Quicko. It barely took me about 15 minutes to file my income tax return. My ITR is already submitted. I've gotten the acknowledgement number right here. So that's pretty cool. We really hope you can also file as easily as I did. There's a lot of help and support available. Just in case you need assistance, you can always go to Meet, which is our assisted product. So we have a large network of chartered accountants from across India, where you can easily book slot online and go into a Meet, and a chartered accountant using our product will help you learn about our product, but meanwhile answer all your queries and file your income tax return. That's a great way to file your income tax return. Rather than it being a black box, you can learn more about your financial situation and how your taxes are reported. A lot of people also think that filing income tax return is the last step. However, once you file your income tax return, you also need to e-verify it. So e-verifying is just an action through which you are confirming to income tax department that it's you who is filing the income tax return. So let's go ahead and e-verify our income tax return. Again, I'm going to choose Aadhaar registered mobile number, click on proceed. So after entering your OTP, just click on e-verify. Awesome. So my income tax return is e-verified now. now I should just relax and wait for my refund to be deposited in my bank account. Meanwhile, what you can do is you can download your ITR verification. So ITR verification is essentially confirmation of your filing. You can also download other supporting documents, including your income tax return PDF, right, for your records. You can always log back in and access your tax documents from Quicko at any time. You can also share it with your chartered accountants or otherwise using Quicko's platform. So guys, that's how easy it is to file your income tax return. There are only 9 days left. So don't wait till the last moment. Lot of time, there's a lot of rush in the last few days. Also, if you file early, there are chances that your income tax return will get processed faster. So again, my request to you, don't wait till the last moment. Don't procrastinate. File your income tax return as soon as possible. And like I showed you, it's very simple to file your income tax return using Quicko. And do give us your feedback on our social media channels. In case you have any question, you can always go to Q&A.tax, which is our discourse channel, where we answer all things related to taxes and compliances. So do follow us on our social media handles. Give a thumbs up if you like this video, and good luck with your income tax return. I hope you enjoyed this video and learned a thing or two about your income tax returns and how to file them. Best of luck.